Hello and welcome everyone at the SJDA website and group. I would like to welcome you all with this interesting talk about financial planning for medics. This talk will be delivered by the expert Jay Thind, who's a financial planner and director at the Thind Wealth Advisory. The Thind Wealth Advisory provides specialist medical financial planning to doctors. And this is going to be a very, very interesting talk that I encourage you to watch the video, watch the live video, all of it. And if you have any questions, comment your question, and then we will be delivering this to Jay. Jay, are you ready?
Yeah, I'm ready to go.
Okay, let's go ahead.
Okay, so hello everyone. As Nadir said, I'm Jay Thind. I'm one of the directors at Thind Wealth Advisory. I'm also head of the medical divisions, where I'm responsible for looking after all of our medics. Some of you may have seen me at the recent meeting in Birmingham. So I talked about NHS pensions, and one of the alarming things that happened on that event was a number of people said they'd opted out of the NHS pension scheme. Now, to me, that's a big no-no. And a big shock, because normally that wouldn't be the case. It'd be a few hands that go up. So I wanted to cover off a little bit more on the NHS pension, as in why you should be in it, the benefits of not only the pension, but the additional benefits that they give you as a pension member. I also wanted to cover off some of the other areas that are important in financial planning. So, for example, legal planning, protection planning, things like that. Just high level, just so you know what you should also be looking at. And then at the end of it, if there's any questions, then obviously you can forward those to me at a later date. So I'm going to make a start just by telling you a little bit about who we are. So as I said, I'm director of Thind Wealth Advisory. So we're a chartered financial planning practice. So we're responsible for providing financial advice, so face-to-face financial advice to clients. We manage currently 115 million of our clients' money. We look after about 250 households, so about 500 clients, and most households are couples. And we have 4 financial planners, 5 support staff, and we're a senior partner practice. So those of you that have come across St James's Place before, they have a number of businesses linked to them that work in partnership with them, and they're basically graded depending on the size and how long they've been running. So an associate is the smallest, it then goes a partner practice, then senior partner, and then principal partner. So we've been going about 13, 14 years. When we get to about 25, then we'll become a principal. So we are sort of a well-established practice. In terms of what we provide, so it's holistic financial planning. Some of you may be wondering, what does holistic mean? So I will come on to that and sort of break that down for you. It's all face-to-face. So pre-COVID, we would normally go and see everyone in their homes at least once a year. But I'm also at the end of the telephone, or if anyone wants to email me questions, my clients can. And all of our advice is bespoke. So we all have our own specialities. I'm doctors, my co-directors and colleagues advise dentists, pilots, and business owners. So we do work in our niche areas. We're not mass market. We don't deal with everyone. We are quite selective, but within those areas, we are very capable. In terms of the relationship for clients, so you deal directly with Thind Wealth Advisory. So you'll have a point of contact. So for all doctors, that point of contact is myself. If you're a dentist, pilot, business owners, that was obviously one of my directors or colleagues. And then what happens is, we put together your financial planning and build the relationship with you. And then on the back of that, there will be products or investments that you need. And those are provided by St James's Place. So they do all the due diligence for us and provide us with the infrastructure to do our job. A bit like for a doctor, the NHS. So without the NHS, you maybe not get the training that you need. You probably wouldn't have the equipment that you need to do your job. St James's Place is our NHS. Think of it that way. So about St James's Place, so why have we chosen to partner with them? Well, fundamentally, they give protection on both ends. They give protection to us as a financial planning practice, and they also protect our clients. So they're the largest wealth manager in the UK, and they continue to grow at a phenomenal rate. They manage 112 billion of client funds, which is on the back of a market crash, which just shows you how big their fund value was. They're a FTSE 100. For those of you that don't know what FTSE 100 mean, it basically means they're one of the top 100 companies in the UK. And the market capitalization, that basically means what's the company worth. So if they were to sell the company, it's valued at 5.3 billion. So again, just gives you an idea of the size of the business. Supported by over 2,000 employees. Our head office, St James's Place head office, is in Cirencester, and they've been founded in 1991. So they've been going a good few years now. So when I talk about protecting you and protecting us as an advice firm, what do I mean by that? Well, one of the great things that St James's Place does is they check all the advice we give. So once we've sat down with you, we've done all the planning, we've worked out what we're going to do, they will then check all of that. So I have to document everything that I've discussed with you and put together a proposal, and that's submitted to St James's Place. So before I get the go-ahead and before we do anything with your funds or with your investments, St James's Place basically have to authorize it. And when they authorize it, what they're also doing is guaranteeing that advice. So let's say we've done something for you, set up an investment, for example, and it leads to you having a tax charge where you're worse off than where you would have been if that advice hadn't been given. They will basically put you right. So it's just an extra protection for everyone involved. So in terms of the actual financial planning side of it, so when I said holistic, this is what I mean by holistic. So there's 5 areas of financial planning. There's legal planning, protection, tax planning, which is an ongoing process, investment planning, again, an ongoing process, and retirement planning. When I'll break down each one individually in my further slides, but if you have a look at the wheel on the right-hand side, it's probably quite similar to a medic in terms of if you take money away from it and you make it a medical thing. So I'm coming to, for example, a doctor with symptoms. You would obviously want my basic information first. So name, address, all that sort of thing. The next thing you're going to look at is maybe medical history and asking symptoms. Why have I presented to you with what's my issue, basically? Once you've got all that information, you can then look at whether you need to do further testing or if you need to ask further questions or what the situation is. Once you've got all that information, you can then make a diagnosis, hopefully. From that diagnosis, you then need a treatment. And from the treatment, I'm going to go away and you're going to maybe want to monitor me. So if you take someone, a typical client, for example, on warfarin, you obviously have to keep calling them back, check their INRs and so on and so forth. It's the same with us. So we're going to basically take all the information up front. I'm then going to go away and formulate a plan for you. That plan's going to need certain investments or products to basically achieve that plan. And then we're going to have to make sure that the path is right. So once we've set something up for you, are you still on course to achieve what you're trying to achieve? Or are you veering off course? And then do we need a correction along the way? And also things change. So legislation keeps changing. So all this help on the back of COVID in the UK, everyone's loving Rishi right now, but they've got to claw that money back somehow. So I expect taxes to rise in the future. It might be that they hit pensions. It might be that they hit inheritance tax. It could be anything. But it's also how do we navigate around that? So whatever they've changed, what can we do to try and minimize the amount of tax we pay? So when it comes to legal planning, so everyone should basically have a will. It depends on where you are in life. So those of you a lot younger, it's probably quite simple. You can just put together a basic will, a mirror will. When you get a little bit more advanced and your assets start to grow and you've got a certain amount of wealth, you then start to maybe look at trust planning. So you might need a will with a trust in it. So my job, I'm not a solicitor, I don't make wills or write wills, but my job's basically to advise you on what structure of will you need based on your circumstances. And then if need be, I'll even go and get the solicitor and say, look, basically put this in place for my client. Once we've done that, we normally review the will every 3 years. So if your circumstances have changed, you would normally do it a little bit sooner, but at least every 3 years just to make sure everything's still relevant and nothing's changed in that time period. Another legal document that everyone should have is a lasting power of attorney. So lasting power of attorney, there's 2 of them. There's health and welfare and there's property and financial affairs. Health and welfare, as doctors, you're probably more versed with this, so it's more making decisions on on someone's health, basically. The property and financial affairs one is more relevant to me and what I do, and I would really encourage everyone to have one. The point of this is, let's say that you've got assets in joint names or just in your sole name. If anything was to happen to you where you lost mental capacity, your spouse or whoever's looking after your estate would have to go to court to get access to your assets and to pay your mortgages and your bills and so on and so forth. And that is a really timely process. So it can take a year before you've got access to something. And it's also a very expensive process, because when you go through the courts, you then got to basically get solicitors and so on involved. So you can end up paying thousands just to get access to your own assets. And in that time period, if it's, for example, a buy to let, you're not able to manage that investment, which can cause real problems. The final point is to look at trust planning. So one example of this is an asset preservation trust. So for those of you that are NHS pension members, you get something called death in service, which I'm going to come on to shortly. And you can place those death in service benefits in a trust today. So you set up a trust now, and then if anything was to happen, it would pay into that trust. If you haven't set one up today, there's nothing for them to pay into. So it basically means that you may have to end up paying inheritance tax on this money if you was to pass away and then your spouse or partner was to pass away soon after. It also means that if there's any sort of marital breakdowns or bankruptcies, the creditors or the ex-spouse can again get access to this money, which maybe, well, it wouldn't be ideal basically in that situation. So by just putting together a simple legal document, you can get through that whole loophole. Then we're on to protection planning. So protection planning is basically insurance policies to cover yourself in different circumstances. So the first one's life insurance. So if you were to pass away, where does that leave your family, especially if you're the main breadwinner? Will they have enough income to live? Are they still going to have a mortgage? So on and so forth. So you'd normally take life insurance that clears all your mortgages, and it may even provide a lump sum that will provide an income for your family when you're not around. Critical illness insurance. This one's mainly for people that obviously get critically ill and need a lump sum to potentially pay down their mortgage, so that they're no longer, because obviously you're critically ill, you can't work anymore, but you still got a mortgage, you still got bills. So you'd probably want to clear your debts and maybe provide again a lump sum to make in a scenario where you're unable to work, and then as soon as you go back to work it stops again, and if anything happens again it restarts. So these are three different insurances that you should really have a look at and have in place. I'd call this the foundations. So think of building a property. You obviously do the foundations first, and if you don't do them right, the property will probably fall down one day. This is the foundations of your planning. So before you look at investments or anything else, make sure you've got this in place. Make sure you've got an emergency fund for things like COVID, and then look at building from there in terms of putting money aside for retirement and so on and so forth. So I'm going to talk to you a little bit about the benefits that the NHS pension scheme gives you other than the pension. So for those of you not aware, there's three different schemes. There's a 1995, the 2008 and 2015 scheme, and it all kind of depends when you join the NHS as in which schemes you're in. You can be in more than one scheme, so you can be in two schemes, like 1995 and 2015 is quite common. And it's just about knowing what those each scheme gives you in terms of benefits, which I'll come on to a little bit later. So this is quite universal. If you're an NHS employee, you get sick pay. So sick pay is based on your service, how long you've been going. So in your first year of service, they'll pay 1 month's full pay and 2 months half pay, and then every year that you're basically still in the pension, or still in the NHS, should I say, that increases in terms of how much they'll give you on full pay and half pay. So eventually, you want to get to a point where you've done over 5 years service, and then they'll pay 6 months full pay and 6 months half pay. So you probably want to factor that in to your protection planning. So the previous slide I was talking about, there's no point having double insurance. If the NHS are providing this, you just need to look at going above and beyond that. There's no point doing it twice because the insurance company won't pay out. Then we've got ill health retirement pension. So this is basically, if you are diagnosed with a critical illness, there's two tiers of ill health retirement pension. So the first one is a lower version, really. So tier 1 is if you're unable to do your current job, but you can do another job. So in that situation, what they'll say is whatever pension you've already built up, rather than having to wait till retirement age, we'll pay it out to you now. But the problem is in the early stages, so if you've only been a member for, say, 2-3 years, you're not going to have a lot of benefits, even maybe 5 or 6 years. So there's not going to be a great deal of payouts. So you're going to have to go and do another job. Tier 2 is a higher level, and that basically means you're unable to do your current job and you're unable to do any other job that's similar to what you're doing in the NHS currently. And in this situation, they will not only pay out what you've currently built up in the NHS pension, they will also give you one half of your benefits up to what your normal retirement age would be. So let's say you're 40 now and your normal retirement age is 67. So they would say, okay, you've got another 27 years of service that you would do. We'll give you half of that, and we'll pay that out to you as well as what you've already built up in your time. So it's a massive benefit, basically. And again, you'd factor this potentially in when you're looking at critical illness, because it's hugely expensive and you don't want to be paying more than you need to. The final one is death in service. So this is all really grim. I'm sorry about this, but it's all important. So basically, if you were to pass away while in employment, NHS employment, and a member, then you get something known as a lump sum payable on death. And there's two versions of this. So the easy way to remember it is normally 2 times earnings. But there is a bit of a quirk there. So there's 2 times earnings in the last 12 months of pensionable service. Alternatively, they will go back 10 years and they will revalue pensionable earnings in every scheme year. So that basically means when it says revalued, you'll see it on other slides as well. It basically means they'll increase the previous values with inflation. So if you go 10 years ago, they'll increase that up to today and make it equivalent to today, because obviously inflation is about 2% roughly every year. So what you earned 10 years ago is obviously going to be a lot higher today than it was then. So it's just making sure that you're getting the maximum that you can out of the death in service there. Again, this is linking into life insurance, so you don't want to double insure again. Another thing they give you is something called an adult dependent pension and a child dependent pension. So this basically means if you pass away, they will pay a pension to your spouse for the rest of their life. But it's a lower amount than what you would have got. So for example, for an adult, it's 33.75% of that tier 2 ill health pension that I spoke about earlier. And for the children, it's 16.875% of that same tier 2 ill health pension. Children, it stops at 23. So they will support them up to 23, and then obviously they're expected to go and get a job and earn for themselves. If they're unable to, so let's say your child's disabled, in that situation, if they can't go and get a job, then they will support them for life. So now we move on to retirement planning. So when we talk about retirement planning, many clients don't actually know how much they need. So especially as doctors, when you get to your 50s and 60s, you're at the peak of your earnings potential and you may be earning 100k plus. And you get used to having that much income coming in. So people think when I retire, I still need that same amount of income, but it's genuinely not the case. So this is a study that's been carried out by Pensions and Lifetime Savings Association, and it shows you how much money do you actually need based on studies to live various levels of various lifestyles in retirement. So the minimum, just to basically get the essentials going, this isn't holidays and things like that, that's just making sure that you've got roof over your head and food. For a couple would be 15,700, and for a single person it's 10,200. Then we've got a middle ground, so it's a little bit up from the essential, but it's not going to be any way comfortable or luxurious. So you're probably talking UK holidays and just sort of a moderate living. So that's 20,200 and 29,100 for a couple. And then finally, we've got comfortable. Now, as doctors, you'll get to a point, if you're not already there, you'll be at a point where you're living a comfortable existence. So you're earning 70, 80 plus. And you've got a nice main residence, you go on a couple of holidays a year, so on and so forth, you drive German cars, all that sort of thing. So if you want to maintain that, bear in mind that you're not working anymore and you shouldn't have any debts by the time you retire, so your expenditure is going to be a lot lower than when you was working and you had children and so on and so forth. So they expect the sort of prediction in terms of what you need for a single person is 33,000. This is after tax, by the way. And for a couple, it's 47,500. Okay, so I'm just going to, on the next slide, talk about how you get to that figure. So calculating your magic number. So if you want to basically continue living a nice lifestyle as a doctor, how do we do that? So let's take the NHS pension out the equation for a second, and let's just say that you're like me and you don't have any civil service pension and you basically got to do everything privately. Well, for myself, if I want an income of 47,500, a gross income of 47,500, I would need an investment pot of £1,187,500, either in ISAs, pensions, some form of investment. And we've assumed on this because when we do investments, our investments generally produce 4%. Now we say 4% because we invest in companies. Those companies make profits. Those profits are paid out to shareholders. So you become a shareholder basically, and they'll pay. And roughly that works out about 4% in a portfolio that we would design for you, whilst managing risk. So that's how we get to that figure. But you've got a huge advantage over myself and everyone else in the private sector, in that you've got the NHS pension. And I'll come on to that shortly in terms of the exact benefits of that. So in terms of generating income at retirement, there's various ways you can do it. And these are some of those sort of suggestions. So a lot of doctors, when they retire, will continue working part-time. Now, this isn't feasible forever. You're not going to continue working part-time when you're 80, 90. So that's only a part-time thing, but it might sort of tide you over in your 60s and 70s. You got your pension, so huge NHS pension's your biggest asset really. So working in the NHS, that's sort of the Hail Mary. You've got your main residence. So when I say downsize or equity release, what some people may do is they want to enjoy their main residence. So they go and buy a larger main residence in maybe a nicer area where they're paying more per square meter. And then at a later date, let's say you bought something at £500,000 today. In 20 years' time, you're saying it's worth £1 million. What they would do is sell the £1 million property, downsize to something worth 700,000-800,000 maybe, and take some of that money out to produce an income, invest it elsewhere. So that's one option. And because your main residence is capital gains tax free, it's obviously tax efficient as well. Buy to let is another option. So this is basically where you buy a residential property or a commercial property and rent it out, and become a landlord. It's basically you're a business owner at this point, because you've got to make sure you're on top of legislation, you've got to provide services, and you've got to collect your rent and make sure that the tenant's happy, so on and so forth. This used to be hugely profitable back in sort of my parents' age, so the previous generation. But over the years, the government have sort of chipped away. So they've increased the taxes. So they took away the wear and tear allowance. They're now taking away the mortgage relief. So you're having to pay tax on interest. Various other things are basically being changed. So this is now a lot harder to make a good profit from. But it's also harder in terms of the maintenance, because as well as chipping away at your profits, they're also increasing legislation every day. So you've got to do more and more. So it's gas safeties, you've got to have smoke alarms, you've got to be an accredited landlord now, and various other things, which just makes it tougher and tougher. And so it's not something that appeals to me, but for some of you that are really keen on property, you may want to do it via a limited company or a different setup to owning privately. And then finally, that box there is investment. So this is really what we do. So this is our specialist area. The main reason we like what we do and we advocate what we do is because of the tax relief. So the government is encouraging you to save for your retirement, and they're doing it by giving you some tax reliefs and certain investments that you can use to save tax. So one of those is ISAs. So some of you may have heard these. It's called independent savings accounts. And it basically means your taxed money you put into the ISA. So you're allowed to put up to 20,000 a year in a tax year into an ISA. Money within an ISA is tax free. So there's no income tax on it, and there's no capital gains tax on it. And then when one day you do want to take money out, so you can access it whenever you want. It's not locked away like a pension is. But if you do want to take money out, it's tax free when you take it out. So tax money goes in, the money in there grows tax free. And then when you want to take the money out, it's also tax free. And you can take bits and pieces whenever you want, or you can take the whole lump sum out at a later date. And then you've got investment bonds, VCTs and EISs, which are a little bit more higher level. So once you maximize your pensions and ISAs, for those clients that have got sort of significant earnings or significant savings every year, and they're able to fill both their pension and their ISAs, then we would look at further investments for those individuals that also have tax advantages. So this is a diagram of what I've just explained. So as I say, ISA, no tax relief up front. Your tax money's going in. You get tax-free growth within the ISA, and then at the end you get a tax-free income or a lump sum that you can take out. Pensions are slightly different, so you do get tax relief on pensions. So when you put money in, if you're a 20% taxpayer, you get 20% relief. If you're 40%, 40%, 45, and so on. Within the pension, it also grows tax-free. But when you come to take the money out, 25% is tax-free, and the remainder is taxable at your marginal rate when you come to take it. When you come to take an income. So hopefully the idea being here is that you're a higher rate taxpayer, an additional rate taxpayer now, and then when you retire, you're a lower taxpayer. So you may be a basic rate taxpayer, and so you're paying a lower rate of tax at a later date, but you still had the higher relief at the beginning. VCTs and EISs, I'm not going to go into this because these are very specialist investments, and they're only for, I'd say, 10% of my client bank in terms of those that have got significant wealth and can take a bit more risk in exchange for tax benefits. So if you do fall into that bracket, feel free to contact me, but it's not for everyone. So in terms of, once we've decided what the tax wrappers are, so whether you've put your money into a pension or whether you put your money into an ISA, that money's now just sat in cash within that tax wrapper. So it's protected. Think of it as like a bubble, and the taxman can't get to it. But now we've got to try and make money within that tax wrapper. There's no point just having cash in it, otherwise you're losing money. So what can you actually invest in? Well, there's only really 5 asset classes that you can choose from. So I've got 4 here, and I'll tell you the other one as well. So the first one's property. I think everyone knows about property. We live in one. We see them all the time. So we're quite well educated on that. The next one's called equity. Some people might call it stocks and shares, but if we just bring it down to basics, it's basically investing in businesses. So everyday businesses, so some of those names you'll have seen and you'll understand: Google, Apple. We've all got an iPhone, or we all use Google on a daily basis. And what we're doing is we're investing in those. So we're taking a very small slice of that business in the belief that over the next 10, 20, 30 years, they will continue to make profits and grow over that time period as well. So that's equities, and I'd argue, well, I'll show you another slide that will show you, but those 2 are the best 2 assets over a long period of time in terms of performance, historically anyway. So we'd expect the same going forwards. Cash, again, we're all well aware of this. We've all got it in our wallets. We have to deal with it on a daily basis. The world's moving a little bit more digital now, but it's not quite died out yet. The problem with cash is that it doesn't earn anything. So if you go to a cash ISA, or you go to your bank and ask for an instant access account with interest rate attached to it, or even a 90-day notice account, the rates are so low now. The Bank of England rates at 0.2, so the bank's not going to offer you a great deal. So if you're not achieving at least 2% a year on your money or anything that you hold, you're losing money, because inflation's 2% a year. So everything's going to go up by 2% roughly every single year. So that figure varies, but on an average basis, the target for the Bank of England, is 2%. So if you think of a pint of milk today, it's going to go up 2% every single year. So in 10 years, it's going to be a lot more than it is today. Okay. The other thing that you can invest in is something known as commodities. So to a layman, commodities are things like gold, oil, wheat, just things that we use on a daily basis, really. These are generally more safe havens. So when equities and property aren't doing so well, for example, COVID, people will panic, and they will take their money out of companies, and they'll take their money out of their properties, and they will invest into commodities because they believe that gold, for example, is a safe place to put your money, or hold it in cash, one or the other. So it doesn't really perform very well over the long term, but over short term, in certain periods of time, like now, they generally do better than properties. So you don't want too much exposure to this, but for those of you that don't want to see too much volatility, so movement in the value of your holdings, then you may want to put a little bit of commodities in there just for diversification. And the final one that's not on this slide is something known as bonds. So there's 2 types of bonds. There's government bonds known as gilts, and there's corporate bonds, which are basically loans to companies. So if you loan money to the UK government, you're going to get a lower rate of interest, because the only way you're going to lose that money is if the government goes under, in which case I think we're all in trouble. With a company, it depends on the size of the company. So the smaller the company, the higher the rate you're going to get, because the risk of you losing your capital is a lot higher. So if you think of your local high street shop, if you lend the shopkeeper, £10,000, there's a good chance you might not get it back if he goes through a hard period. if you go and give £10,000 to a Google, a Nike, a MasterCard, any of these multi-billion pound businesses, the chances are someone's going to be willing to buy your shares and you're likely to get that money back. And there's a very low chance of those companies going under, even in volatile times. So that's basically fixed interest, and that's how bonds work. So this diagram that I've put up now, the chart should I say, so this basically shows you between 2010 and 2019 how the different asset classes have performed year on year. So if we take 2019, we've broken down equities into region. So you've got US equities was the best performer in 2019 and it achieved 31%. Emerging markets was next, that was at 25%. And for those of you who don't know what emerging markets are, so it's places like Brazil, Russia, India, China, South Africa. European stocks, so that's obviously covering the whole of Europe, was at 25%. Then we had the UK at 19%, Far East at 19%, and then commodities were at 8%. Bonds, so government loans to governments was 7%, property was 1%, and cash was 1%. But if you look at every single year, it varies. So no one asset class or region has outperformed every other. It changes on a year-by-year basis. And we don't truly know what's going to happen next year, in the next 2 years, or the next 5 or 10 years. So we do look at the past for a bit of a barometer in terms of what do we think is going to happen. But there's no guarantee that the past is going to be the same as the future. So what we do to mitigate risk is we put a little bit in all these different asset classes. So if we've got a little bit in each, put our eggs in each basket, then when they do go up, or if a certain one outperforms another, then we know that we're still making an average return. Because that's all we're trying to do. We're trying to do an average return over a period of time, and so that's why it's important. This basic slide is showing you visually the importance of diversification and why you wouldn't put all your money in one basket, for example, US equities, because you don't know year on year how it's going to perform. This diagram is not very clear. I did try and make it a bit clearer, but I really like it, which is why I've put it in. So I'm going to talk you through what you're looking at here. So the different lines represent different asset classes, and there's a couple on there that show it inflated. There's one at the bottom that shows inflation as well. So at the top it shows you each event that's happened. So for example, the dot-com bubble in 2000 is on there, and it shows how the stock market crashed after that. The subprime loans, so in 2008 the crash, the Lehman Brothers collapse and so on, that's on there. So again, where you can see the dip. But what this is showing is if you put £100,000 you had invested £100,000 in 1987, what would have happened based on which asset classes you would put your money in, basically. So the first thing is the bottom line there, it's showing the 100,000 went to £291,900. Now that figure there is inflation. So if your money didn't at least do that, you've lost money. Okay, so when you go to buy your pint of milk and so on and so forth, you're having to pay a lot more than what you had saved in cash. The next line is cash as in a fixed interest account. So if you'd gone to the bank and taken a 90-day notice account, for example, what sort of return would you have seen on that? And that's at 466,000. So it's still done well. So it's beaten inflation, but it's not shot the lights out. The next line is the purple jagged line that you can see. So you'll notice with this line, it's not as volatile as the red and the blue lines. The reason being is this is fixed interest. So generally you're loaning money to a company or a government, and in exchange you're getting a fixed amount of interest every month. So the variation in value isn't huge. It's just a case of you trying to find new deals at the end of each agreement. So if you'd put your money in fixed interest or bonds, you'd be looking at a return of just shy of 1.1 million, right? So it's £1,099,470. Finally, we're on to equities and properties. Now, historically, these two have both performed really well, sort of identical almost. And it's more a case of looking at the tax point of view on these now, as opposed to and the obviously upkeep and maintenance, as opposed to which one's going to do well in the future. I think they'll both do well. So the red line is UK commercial property, and the blue line is UK equities. And it basically shows that if you had put £100,000 in 1987, left the money there, so any income paid was reinvested in more stocks, so you kept on buying more and more of the same. you would have been looking at a return of £1,695,320 if it was in equities, and £1,723,282 if it was in property. So they've both done really well, and that's the effect of compounding. So for those of you that aren't aware of it, Google it. Compounding is a massive tool to be using when looking to invest your money. And depending on where you are in life, so one thing we do have to do here is manage risk. We also have to manage volatility. So for those of you that may be approaching retirement, it's not going to be appropriate for you to see these huge fluctuations in the value of your holdings. So we're going to need to pad it out a little bit with fixed interest, cash, commodities to try and reduce that volatility, but still having some equity or property in there to still get a positive return. Those of you younger than my age, sort of 30s and sort of 30s, 40s, you've still got some time before you retire, so maybe another 20, 30 years. And in that case, I would probably go more heavy towards equities and property, and still keep some fixed interest fixed interest and commodities in there, but a lot lower, because otherwise you're basically not going to make the positive returns that you possibly could do by having more exposure to the better asset classes. So now I'm going to move on to the NHS pension, and in terms of the benefits you get there. So everything we talked about up to now in terms of investments is what you can do privately, so outside of your NHS pensions. And for those that don't have NHS pensions or access to them like myself, that's what we have to do. You've got a special thing here in the NHS pension. It's changed over the years. As you can see, there's 3 different schemes, and every year they've changed the benefits, and probably for the worse. But it's still a cracking scheme. It's still something that I would readily sign up to if I could, but there's nothing in the market that's available for someone like myself. So what do you get? So for those of you that joined sort of between 1995 and 2008, you would have gone into the 1995 scheme. And this is a final salary scheme. So what does that mean? It basically means they will base your final salary on the last 3 years before you retire. So let's say the retirement age on this is 60. So when you get to 57, your earnings between 57 and 60, which should be the peak, should be the highest earnings in your career, they will base it on the best of those final 3. So whichever year in the final 3 is the best, they'll do it on that. So you should get the maximum benefit from that. The build-up rate is a 1/80th. So what does that mean? So the 1 is basically the number of years you've been in the scheme. So if you've been in the scheme for 10 years, you would take 10, divide it by 80, and times it by your final salary. And that'll tell you how much pension you'll get. Okay? Once you work that out, you also get a lump sum. And this is a tax-free lump sum. And in this pension scheme, the tax-free lump sum is 3 times, whatever the pension value is. So let's say that pension value is 20,000 a year that they're going to pay you. You'll also get £60,000 as a lump sum in addition to the 20,000 a year that you're going to get. Okay, so this was a really good scheme, but it's more for the previous generations because their life expectancy was a lot lower than ours. So for them to continue with this scheme for our generation, who's expected to live 90, 100, it just wouldn't be affordable, and they were struggling to keep up with it. So they had to make changes. So they then brought out a scheme in 2008 where they changed things around. Still final salary, slight change to the way they calculate final salary. So rather than the final 3 years, they go back the final 10 years and they look at the 3 best years in that final 10 years. And that's how they work out what your best final salary is. The build-up rate now is 1/60th. For those of you that are good at maths, you'll realize that that's actually an increase. So it means this is a positive figure. You're getting more. So if you take, again, the same figure, 10 years of service, divide it by 60, times it by your final salary, that's what your pension is. But the 2 big differences here you'll notice is they took away the automatic lump sum. So the 3 times lump sum doesn't exist anymore. But instead, what you can do is give up some of your pension, so that 20,000 a year, for example, for a lump sum. So they'll say, all right, instead of giving you 20,000 a year, we'll give you 15,000, and then we'll give you a lump sum of, I don't know, whatever that works out to be. They've also moved the pension age. So instead of retiring at 60, you've got to wait till 65 to be able to access it. With all of these pension schemes, you can go early. So if you don't want to wait till 65, you want to go at 63, or you want to retire at 62, you can. The only thing is they will reduce your benefits by 5%, roughly about 5% for every year you go early. So the figures are on the NHS Pensions website, but as a rough guide, use 5%. So if you're going to go 5 years early, for example, you go at 60, you're looking at 25% reduction in your benefits, which is obviously a big hit. So for many people, they'll probably want to wait until the actual retirement age. And then in 2015, they really shake things up. Again, everyone's just living longer. It's not affordable. They had to make changes. So it doesn't mean the scheme's not a good scheme anymore. Maybe not as good as it used to be, but it's still a cracking scheme. It's just we're living longer. So where someone in their 60s would live till 80, they've had 20 years out of this pension scheme. Well, someone claiming at 67 is likely to live till 97. Or around those sort of ages. So they had to move the ages along a little bit. Just to be able to keep up with it. So what they've done is they've linked it to the state pension age, which for my generation is 68. For many others, it'll be 67. But it's subject to change, and that obviously makes it easier for the government because they now don't have to keep changing the scheme. They can just move the pension age at the state pension age, and that will automatically change your pension. The lump sum, there's still not one, obviously. The build-up rate has increased even further, so you'll notice it's a 54th as opposed to a 60th or an 80th. And the other thing they've changed on this one is it's not a final salary anymore, it's a career average. So what they do is every single year you're building up another pot. So it's 1 divided by 54 times by whatever your salary is this year. And then the same happens next year and the following year and the following year. And at the end, they'll add up all these pots for you and tell you what your general, what your pension is going to be. An easy way to think of it is if you're earning, say, 70, 80 today, and then you go on to become a consultant and you're earning 120, 130, the middle ground will be somewhere around 100,000 as your final salary, depending on how many years you do at both ends of the spectrum. So in terms of the changes and how they've affected you, there's a better accrual rate, which is a positive. So that 180th, the 160th, 154th, that's accrual. So that's going up in the right direction. You're getting a bigger slice. But then obviously they're taking something away from you. So you've got to wait longer to receive the benefit. Part of that's also because there's not enough doctors, so they need you to work longer, but also you're living longer. The early retirement factor, which I talked about, roughly that 5% reduction for every year you go early. So because of that, you may want to look at building up other investments on the side. So if you're adamant you want to retire, for example, at 60, you probably want to build up ISAs, pensions, other investments to be able to produce an income for you before you can fully claim your pension. So you might go part-time and then use some of your investments until you fully retire and receive the whole pension at 67, 68, whatever it might be. And then obviously at the change of earnings basis, the change from final salary to career average is what that's in reference to. So pensions taxation, there's been some changes in legislation recently. Annual allowance was really tripping up a lot of doctors in recent times, but Rishi Sunak, the Chancellor's made some changes which hopefully will improve that now. So there's two things you need to be mindful when you're putting money in pensions, which is obviously a no-brainer. It's just to make sure you don't go over your annual allowance, which is the maximum amount you can put into your pension annually and receive tax relief. So you can put more if you want to. So we all start with 40,000 a year, but let's say you put 50,000 in. They're not gonna stop you doing that, but you won't get tax relief on the extra 10,000 that you put in above your allowance. So you could consider that a bit pointless given what you're trying to achieve. Lifetime allowance, quite similar, but instead of being on an annual basis, this is how much you can put into a pension over your lifetime and receive tax relief. So again, you can put more, but then you're just going to get penalised on taxation later down the line. So ideally, you probably want to stick to the provisions that have been given. So the lifetime allowance has tumbled over the years. It started at 1.8 million, then 1.5, 1.25, then 1 million. And then since the 1 million mark, they've linked it to inflation. So it goes up by something called CPI. CPI is the Consumer Prices Index. So it's a measure of inflation. So that's why you're seeing that figure slowly creep up every year. I don't know if that's going to change and pensions will be targeted on the back of COVID and the government trying to claw back some of the money that they've been paying out as a result of furlough and so on. But at the moment, it's still going up and we're at 1,073,000 currently. So how do you calculate your lifetime allowance? Well, for those of you that are in the NHS pension, if you take that final salary pension figure that I told you how to calculate, you times that by 20. You then add on any lump sum. So for those in the 1995 scheme, add that final salary lump sum on top, and that will give you how much your NHS pension benefits are. Sorry. And then what you can also do is if you've got a private pension, you need to add on whatever the value is today. So if you've got £50,000 in a private pension, you would add that onto your NHS pension benefits to give you your overall pot value. And if that's too far, you don't understand that, feel free to reach out and I'll obviously help you with that. But the main thing here is that you want to try and stay below the threshold. So if you do go over the 1,073,000 figure, what they do is if you take the amount above the 1,073,000 as a lump sum, they will tax it at 55%. If you take it as an income, you basically are taxed at 25% on top of your marginal rate. So let's say you're a higher rate taxpayer, your marginal rate is 40%. So they add the 25 onto 40%, and then you're paying 65% on the amount that you've gone over 1,073,000 by. So it is a big tax to be paying at that point, and it might not make sense. So it's something to be looked at because obviously you're still getting huge contributions from the NHS. So there are circumstances where it's still potentially worthwhile being in the scheme, even with all these taxes. So this is an example of how you reach that 1,073,000 using the calculation I told you. So this is assuming you're in the 1995 scheme where there's a 3 times pension lump sum. So basically £46,652 of pension times by 20 comes to 933,000-ish. Add on the tax-free cash of 140,000 nearly, and that takes you to 1,073,000. So if you don't want to go over the 1,073,000, that's the maximum pension you can get. If we relate this back to the 2015 scheme where you don't get a tax-free cash automatically anymore, I worked it out roughly to be about £53,650 of maximum pension you can get to. So if you do enough service in the NHS pension, you potentially don't need any further investments outside of this to reach your retirement figure. If you remember the beginning slides about being comfortable, it's 47,500 for a couple. Well, if you're earning 53,000 minus taxes, you're probably there or thereabouts. So it's just about having enough service in the pension scheme to build up enough benefit. And obviously they're giving you a huge contribution towards that. And I'm not going to cover that off today, but if anyone does want any further information on that, just feel free to reach out and I'll do the maths with you. So annual allowance for the NHS, slightly different to private. So private's just a case of if you put 10,000 in, you've used 10,000 of your allowance. For the NHS, it's a lot more complicated. So what they basically do is they look at what your pot value was at the beginning of the year, and then they work out what your pot value is at the end of the tax year, and they will increase the beginning of the year by inflation, and then they will work out what the difference is between the two figures. So what is the value at the end of the year and what's the value at the beginning? That difference is what your input is, so how much of the annual allowance you've used up. And if you have a banding increase, where your salary jumps up, that can cause a huge input period because all your benefits balloon, because obviously either it's final salary or you're on a career average. That can make a big difference to how things are worked because it's based on you doing 10, 20 years of service and then your salary totally changing, which bumps up the numbers. So you just have to be a bit careful of that. So when they do annual allowance calculations, there's 2 figures they look at. The first one's known as threshold income. Now this was what was tripping everyone up because that threshold income figure used to be £120,000. So a lot of doctors, especially consultants, with your CEA awards, additional PAs, overtime, so on and so forth, were triggering the 120 mark. So they were on 130, 140, 150. So that was causing problems. So the way they actually calculate the figures is all your income comes together. So it's not just your NHS income, it's any rental incomes you receive, any dividends from companies, any pension income. So everything comes together. They then minus any personal contributions you've made. So the contributions you make to the pension scheme, to the NHS pension or private. And if that figure used to be 120, that's now been changed to 200k. So if you're below 200,000, every year your annual allowance is £40,000 and you're safe. You don't have to worry about it being reduced. If you think you'll go over 200,000, then there's a second calculation to be done. And that's called the adjusted income. So adjusted income is very similar to the previous one. The only difference here is they take all your income and then they add on the pension inputs. So your pension contributions are added onto your income to work out where you are. And obviously with the NHS, like I said, sometimes it can cause huge inputs. So if you add a huge input onto your income, you could end up in a sticky situation. More so previously. Now they've raised the threshold and the adjusted income figure to try and save doctors getting taxed, especially during a period like COVID when you've been putting your lives on the line. So the figure now is 240,000 for adjusted. So first 200,000. If you don't go through that figure on income, you're safe. If you do go through it and then your pension contributions are added to that, if that goes through 240, then you've got a problem. If it doesn't, again, you're safe. So it's just something to be mindful of on a taxation point of view. This is how they taper it. So as I say, everyone starts the year with 40,000 that they can put into their pension and receive tax relief. But for those that are high earners, this is taken away because the government doesn't believe we should get that much benefit. So the 40,000 can be reduced all the way down to 4,000, which is the minimum that anyone can have. And the way they work it is for every £2 over the adjusted income, the second calculation, they take away £1 of your allowance. So, and that obviously those figures are between 200 and 240. So threshold's 200, adjusted to 240. So it's based on you going over that amount. So when you get to the point where your earnings are over 240,000, you can see in that chart how slowly start to reduce your annual allowance. So when you get to over 312,000, that's the point where you're at 4,000 annual allowance. But for most doctors, I don't see this being a major issue unless you're doing a lot of additional work or management duties in the NHS, not privately via limited companies. Then I don't see many people having this issue. So just to summarize my presentation, it's not how much money you make, it's how much you keep, how hard it works for you, and how many generations you keep it for. And that's a quote I normally put up on a lot of my presentations. It comes from Robert Kiyosaki, who wrote the book Rich Dad Poor Dad. It's a great book if you want to sort of further develop yourself. And it's true in terms of as doctors you will be high earners, but if you're not smart with your money and you don't make the right decisions today, in the future you might not have enough to be able to sustain the lifestyle and support your families and so on as you want to. So it's just about being smart with your money. If there are any questions, obviously feel free to send them over to me. And these are my contact details for those of you who do want to reach me. So that's my email, personal mobile number, and you can also follow us on Facebook, Instagram, LinkedIn, where we put up regular posts on all topics from stamp duty to income tax to dividends, various educational topics. Nadir, that's it. Basically, I'm all over with. I'll let you come back.
Thank you very much, Jay. That was a fantastic talk, and I have to say, I personally learned a lot from it, and I'm pretty sure that the majority of people, or if not all of them, have learned actually a lot. But thank you very much. Let me just give you a quick update. So I put on a poll about the NHS pension. The question was, are you a member of the NHS pension or not? The results are slightly better than what it was on the AGM, but it's still on the low side. So 46% voted yes, and a 54% voted no.
So still majority and
yeah, no. But hopefully after you talk, people will change their mind.
Yeah, well, hopefully. This is my aim. If I can get the group to a point where they understand why they should be in the scheme and the benefits of it, I would like to see those figure nearer sort of 90-10 or 80-20 at least. At the moment, I can't believe that it's anywhere near 50-50.
Yeah, we're getting there. I've got a list of questions actually from different. I'm not going to name, but from different people there. But I'm not sure how much time you have. But let's go through them, if that's okay with you. So one of them asking about coming out to the pension. So he said, I started working in 2012, and I was a member of the NHS pension scheme 2008. I came out of the pension scheme in 2019. Can I go back to the 2008 scheme?
So the chances are, if you're going to opt back into the scheme now, you'll be ending up going into the 2015 scheme. But this is a little bit up in the air at the moment because everyone was forced into the 2015 scheme, or the majority were forced into 2015 scheme in 2015. So, but it was based on your age. So if you was younger, you ended up in the 15 scheme. If you were sort of early 50s, there was a transition. So it was a case of you're not going to go straight into the scheme in 15, but we're going to move you out your old scheme and put you in the new one over a period of 2, 3, 4 years. And then there was those that are nearing retirement who were left in their old schemes. They didn't move to the new one. Now, this has basically been challenged at courts, and it's been ruled as age discrimination. So the government has basically lost this case, and they're now having to rectify the situation. So it's in consultation, and they're talking about putting everyone back to the scheme that they were in for a time period. So what will happen is between when they've opted you out, so between 2015 and 2022, you'll go back. Well, you've got a choice basically. You can stay where you are, or you can go back to your previous scheme. And then from 2022, everyone, regardless of age, will end up in the new scheme. So, I would definitely opt back in. I think at this stage, you'll probably be opting back into 15. But if that, depending on what happens with that consultation and how they're going to do it, because I think at the moment they're sort of playing between whether to give you a choice of whether you go in or make it mandatory that everyone goes back to where they are, and then we'll move you a later date. But that's not been decided by the government yet.
Okay, thank you. The next question, I think you answered that through your presentation. It's what's the maximum pension contribution per year, and what's the percentage of tax will be taken off any contribution beyond the allowance?
Okay, so basically your contribution, as I said, everyone starts with 40,000 a year that they're allowed to put into their pensions. That's obviously tapered down depending on income, but I wouldn't have thought many of you are going to get tapered now. So I'd stick to that 40,000 figure for most. In terms of what relief do you get, it really depends on how much you earn. So in terms of how income tax works, normally the first 12,500 of income, it has zero tax, so you don't pay any tax on it. Then between 12,500 and 50,000 pounds, you pay 20%, and they're known as basic rate taxpayers. Between 50,000 and 100,000, it goes to 40%. And then there's a little quirk that most people don't know about, but between 100,000 and 125,000, you lose that personal allowance, the 0% of 0 to 12.5. So that tax rate actually goes up to 60%. So it's the 40 plus the 20 that you're now paying on the amount that used to be free. So that's a dangerous area to be in, 100 to 125,000. And then from 125 to 50, it goes back to 40, and then above 150,000, you're 45%. So depending where you are on that scale, the contributions are reduced off your income. So let's say you've got a situation where you're earning 125,000, and between 100 and 125, you've paid 60%. Well, if you make a £25,000 contribution to your pension, it reduces your taxable income down to 100,000. And so instead of paying 60% on that money, you've now not paid, you've basically saved 60%. And if it's at the 20% bracket, you save 20. If it's at 40, it's 40. And if it's 45, it's 45. So it very much depends on your income.
Okay, so that's very helpful actually. One of the members asked, how early can I request the pension, and can I request it in lump sum? I think again you answer this.
Yeah, so in terms of the NHS pension, you can request it anytime after 55, but for every year you go early, just bear in mind it's a 5% reduction in benefits. So for someone that's obviously in the 15 scheme, where your benefits are normally at 67, you obviously got a huge, you're going to take a huge hit, aren't you, to take it that early. So just be wary of that. But 55 is the retirement age currently. In 2028, that's going to move to 57. So that's just something to be mindful of. If it's a private pension in the UK, you can actually take the full pot whenever you want after 55. So that's slightly different.
Okay, thank you. Another question here. It says one of the concerns that urge them to come out of the pension scheme is the interest in investing in properties, crypto, do kind of day trading and so on. What do you think about this?
Sorry, Nadir, are we basically saying the NHS pension against crypto and all the other asset classes?
Yeah.
Okay. So basically what it comes down to is I myself obviously invest in equities. I'm sort of well versed in that area, and the problem is that when we invest in this, we manage risk by investing in the largest businesses around the world, and we invest in only no, sorry, we invest in multiple businesses. So we'll take the top 50, 100 businesses and invest in that, so that we know that even if we were to, let's say we've invested in 100 businesses, even if one of them was to go under, so let's say Google was to go under, we've only lost 1% of our money. So it's not the end of the world, but most clients' portfolios are even higher than that. So maybe have 200 plus businesses in a portfolio. With the NHS pension, regardless of what happens in the world, so if we have a world war or anything like that, stock markets will plummet, right? And we're going to go through a period of volatility and uncertainty like COVID. It caused the stock markets to crash, and they went down 35%. Now, fundamentally, the stock market always rallies from the low points. It's been through world wars, we've been through pandemics in the past, and what happens is it keeps on going up and up and up and up, and that's why someone like Warren Buffett is a very wealthy individual. If you're willing to sit in the market or in any good investment over a long period of time, 20, 30, 40, 50 years, you're going to make money, as long as you've invested obviously in the right things and you've done it intelligently. The NHS pension is a guarantee, right? So it gives you security that no one else can give you. So this, when they say they're going to pay you 40, 50,000 pounds for the rest of your life, that's not dependent on what happens in the world in terms of if stock markets are doing well or if the NHS will invest the money wisely. That's the government backing it. So that money is as secure as it can be. So for someone that's really affluent, so if your net worth is 3, 4, 5 million pounds, then I'd say to you, yeah, you probably can build up a bit in the NHS and then opt out and go and do other things, because fundamentally you're unlikely to lose all your money and you'll have enough for retirement. For someone that's just about getting to the £1, 2 million pound mark, I probably would say the NHS gives you a security that you can't buy elsewhere.
That's probably also answered the following question I'm going to ask. But anyway, what's your comments on the impending doom and the financial crisis that everyone is talking about at the moment, especially with the COVID? It seems to be a huge concern.
All right. So fundamental. Sorry, have you got another bit to that, Nadir?
No, that's fine. Basically, it seems to be a huge concern to chip in at this stage.
Yeah, okay. So fundamentally, the COVID has caused a lot of uncertainty. It came out of nowhere. We didn't plan for it. And I can talk for the stock markets, for example. The stock market always factors in advance. So what happens today isn't what the stock market's reacting to. It's reacting to what the effect of what happened today is going to have in the next 18, 24 months. So when COVID hit and the stock market went down 35%, it was on the back of not knowing how this is going to affect businesses, which business is going to survive, which ones are going to go under, so on and so forth. So you see the worst of it. It's fear really driving the market, because still, it's human beings, whether they're professionals or retail investors. Everyone on the end of the investment is a human being, and we all panic. It doesn't matter how educated we are or how well versed we are. When we see our money go down, it's natural human instinct and emotion to think, panic or worry that I've lost my money. But the key is that if you've done it wisely, if you've invested in the right businesses, you've paid the right amount of money as well. So that's the key. You can go and buy Google, but if you're buying it at 10 times its value, you're going to lose money, because fundamentally you've overpaid. It's like anything in life. So it's about buying the right businesses at the right time and then holding them. So for example, I've got holdings. All of our clients have got holdings. Not a single one of our clients has taken money out at this time. If anything, as soon as this hit and the market fell 35%, my experienced clients called me up and said, can I put more money in? Because this is the perfect time in terms of buying for value. We're buying businesses that are now trading at 30, 40% down from what they're valued at. So why would you not invest in these businesses at that time, sit it out, and then I guarantee you, as soon as the vaccines come out for COVID, stock markets will return. On the property front, I think that especially on residential property, I think it very much is a supply and demand market, and we haven't got enough UK homes. It's why they tax buy-to-let investors so heavily. They don't want people to buy, or investors to be buying property, because they want those properties to be available for young families that are trying to get on the property market. So they're building, I'm sure everyone, wherever you are in the UK, you're seeing houses pop up left, right and centre from these new builds, but they can't build fast enough. The population is outstripping the build rate. So they need to start to release some of the stock that buy-to-let investors have got. And the only way they can do that is by taxing it and making it harder and harder to be a buy-to-let investor. So I think in the future, this COVID situation is only a 2 or 3 year thing maximum. I think the future will carry on the same as we got through World War One, World War Two, Ebola, and all the other various diseases. I just think this is another one of those. The graph that I showed you, all those little ups and downs. This is just another down. We'll see it rally in the next 5-6 years.
Okay, thank you. One question is it too late to go back to the pension scheme?
In the NHS pension scheme?
Yeah, to the NHS pension scheme.
It's never too late, no. So as long as you're still working in the NHS, you can opt back in at any time. So if you've opted out just because you didn't understand it, you didn't understand the benefits of it, you can always opt back in. The only time you might not be able to is if you've retired, taken benefits, especially if you're a 95 scheme, then you can't go back into the new scheme. So once you've retired, you're retired. But if you haven't obviously done that, you can go in at any point. And it's a shame because I haven't. It's very difficult for me to show the benefit of what you get. But if you compare what you get in the NHS pension against what you get privately, so if you gave me £20,000 privately to invest in equities, and then you gave me £20,000 or the NHS, you put it in the NHS, the benefit that you're getting from them is huge, and it's unlikely that anyone can match that. To the point that if someone wanted to transfer a private pension to me and had an option to do it into the NHS, I would always have to tell them they have to go to the NHS, because when we do our calculations and comparisons, we can't beat the NHS pension scheme. One, because it's a guarantee, and secondly, because the benefit they give you, the employer contributions are massive. So don't think of it as it's currently 20.68 that they pay in, and yours is on a sliding scale. So the maximum you're paying in is 14.5. The majority will be paying 13.5 for consultants, and so on will be paying 13.5 of their salary. That don't look at those figures. When you actually do the maths on it, the skew is a lot bigger. They're paying 70% probably of your benefit. So when you've got a pot value, actually have a look yourselves. If you go on your total reward statements, so you can log on online, go on total reward statements, type it into Google if not, register your details, and then on there you can get your statement. On the statement it'll show you what your benefits are. In one of the boxes in the benefit statement, there's a box that says hypothetical annuity value, and it basically meant that if you went privately to get the same benefits from an insurance company, how much money would you have to pay them as a lump sum to get that benefit? And normally it's like over £1 million, and you've only paid in 500 or something over your time period.
Okay, I think that's all the questions. Let me just have a look at the page. I think that's all the questions that I have. Once again, thank you very much, Jay, for all the valuable information, for the great presentation, and I'm sure you'll be around with us for further presentation in the future. And I think you got your contact details there. If anyone from the SJDA member are willing to email or contact Jay, feel free to do so, and we wish you all the best. Thank you very much.
Brilliant. Thank you, Nadir.
Thank you.
Take care. Bye.